Hello and welcome to another episode of Weekend Investing Specials. We do data-backed studies on various aspects of the market and hope that these sessions improve your knowledge and give you some new ideas to think about in your investing journey. So today's data-backed video is full of data, and we are going to study how the markets from every peak and bottom have behaved, and we will add our favorite asset allocation to this thesis and see how, if you were asset allocated from these bottoms or peaks, you would have performed. So one case is just investing in equity. The other case we are making is maybe mixing equity with gold and doing a monthly rebalance of that combo. So general phenomena, from market peaks, from every market peak, and in the last whatever 45 years chart that we have, you can say significant peaks are the 1992 Harshad Mehta peak, the dot-com 2000 peak, the GFC 2008 peak, the pre-COVID 2020 peak, and whenever we will make the next peak. These are the big sort of peak points of the market in the last 45 years. Bottoms have been April 1988, I'm sorry. Then there was, significant bottom after the dot-com crash. Of course, there was one here as well, but it was sort of consolidation, and really the next phase came from here. And then there was, of course, the March 2009 bottom and a COVID bottom at April 2020. So these are the data points from where we will initiate our study. The general phenomena that has been seen so far is that from a market peak, if you see, gold outperforms equity. And from market bottoms, if you calculate till today, equity outperforms gold. This is pretty much the expected outcome also. And right now, because the market has been going on for some time, a lot of folks are of the opinion whether this is coming nearer to a peak. Some others are of the opinion no, the peak is still far away, and yet others think that it may take some consolidation and some bottom may come in. Nobody really knows what is going to happen. So this study is basically going to tell you that if you think that we are near a peak, where should you be in terms of your asset allocation? If you think we are nowhere near a peak, where should you be in asset allocation, and how does asset allocation sort of ensure that your journey is enjoyable? I think most of the investment portfolios that I have come across, there is always some sort of nervousness, tension, and people who are probably exposing themselves to higher risk parts of the market, or are leveraging, or are, you can say, overexposed to the equity in terms of their overall allocation. They always remain a bit fidgety, and they are never calm and peaceful in their mind, because they know in heart of hearts that they are doing something which is, you're pressing the pedal too hard, and if things were to go wrong, it can really go wrong. So that that greed to get that extra percentage or extra juice out of the market system can sometimes get juices out from your own self, actually. So from uh, a asset allocation, we are not going into any other asset allocation, but just simple gold. So we'll take Sensex and gold. Sensex because we have data going back pre 1990 on that. And let's analyze what was the CAGR, max drawdown, volatility from market peaks and bottoms. Simple as that. And see what are the results. So let's take part A is market peaks. So we will consider these four market peaks. So 1992, Harshad Mehta's, and I want you to appreciate what Harshad Mehta period did. I mean, just look at where Sensex was, somewhere near 400, maybe even less than that, by late in 87 or early 98, 88. And within 3 years, you were near 4,500. So 10x in 3 years. Imagine Nifty doing 10x in 3 years at any point of time. It's difficult to imagine. I mean, In next 3 years, if Nifty were to go 2.5 lakhs, that's what we're talking about in terms of what heady moves these were in Harshad Mehta period. Difficult to imagine now because market has mellowed down a lot versus what was going on there. So 100 rupees invested in 1992 at the peak, at the Harshad Mehta peak, and you have September 2024, Sensex 1935. If you invested in Sensex, your 100 would be 1935. If you invested in gold, 100% gold, you would be at 2154. This itself will surprise a lot of folks. That over a period of almost 32 years, from this point at least, from the peak of the market, because most people come in at the peak of the market, uh, gold has beaten Sensex, but that is not the purpose of gold. So I always say don't compare gold and index returns for the returns perspective. Think how gold can improve your overall volatility of your portfolio and smoothen out your equity curve. So the case where what I'm saying is Sensex and gold 50-50 portfolio where you're rebalancing to equal weight every month, that 100 rupees became 2898. Can you see the huge difference between what just Sensex gave you and what Sensex and gold gave you? Isn't that amazing? Anyhow, let's go to next peak. And even within this, if you were at 50%, 50%, your your CAGR would have been better than 100% Sensex, and your max drawdown would be at 26% versus 56%, and your volatility is down to 13.5 versus 23.9, and ROMAD ratio, which is returns over max drawdown, the higher the ROMAD ratio is, the better is your risk adjusted returns. So 0.41 versus 0.17 here. Amazing performance of equity gold from April 92 peak. Next peak, March 2000, dot-com peak. A whole generation was stuck at this peak. So if you bought near this peak, what would your 100 rupees would have done in Sensex? You would have 100 would be 1522 today. If you had invested just in gold, you would be at 1695. And if you invested in gold and Sensex 50-50 portfolio, you would be at 2021, over 24 years. Are you beginning to see the impact of asset allocation? And you, in each of these charts, you will see the blue line is the smoothest one. So again, 100% Sensex, CAGR 11.7, 50% Sensex, 50% gold, 13% CAGR, max drawdown again 56% and 26%. Volatility down 21 to 13, ROMAD ratio 0.48 versus 0.21. Again, amazing performance by the mixed portfolio. Now let's take GFC. January 2008, everybody and their grandmothers wanted to buy the index. 100 rupees invested on 1st January 2008 is today 409 rupees. 100% gold invested on that day is 657. This would be shocking to many. And 50-50 gold and Sensex rebalanced monthly is at 611. Much higher than just the equity market. Again, what are the returns here? CAGR 8.76 on Sensex only, 11.4 on Sensex and gold. Max drawdown also down dramatically. Volatility down dramatically. ROMAD ratio is at 0.42. 75% gold would have been better, but 50-50 is also not bad. Let's go to next one. January 2020 peak. 100 rupees invested in Sensex is today 201. All in gold was 199. Rebalanced with gold is 207. All pretty much same, but just see the characteristic of this move. Very smooth. Hardly any drawdown in blue versus the drawdown in black. Numbers here, CAGR slightly better with the mix, max drawdown much lower, volatility much lower, ROMAD ratio much higher, 1.36 versus 0.55. So these 4 peaks we have seen. What is the summary? Summary is that from each peak, the mixed portfolio of Sensex and gold 50-50 rebalanced every month has given an average return of 13% versus pure Sensex at 11.5%, and gold pure gold was at 12.4. So the mixed portfolio has performed better than either Sensex or gold. That is an amazing outcome. Max drawdown, the drawdowns in only were big ones. In gold also not so small, but when you combine these two, it is very, very tolerable. Minus 12% in the last one actually. And if I were to look at the volatility, the average volatility has been reduced dramatically from 21.2 in pure Sensex uh, and 15.3 in pure gold to 12.6 in the Sensex and gold uh, uh, portfolio. Now, second part is where you look at market bottoms. Obviously, if you will have an imaginary luck of catching the market bottom, it is likely that your outcome will be very superior when you see over 20-30 years, but you will again be shocked to see this data. April 1988 bottom, 100 rupees invested there is today 20,813, amazing return, no doubt. 100% invested in gold is only 3659, and in the mixed portfolio is 13,423. So definitely, from if you were to pick the bottom and only stay invested in equity, you would have beaten the other options. But what is redeeming here is that if you were 100% invested in equity, your CAGR was 15.73, your max drawdown was 56%, volatility was 27, and ROMAD ratio was 0.28. Whereas the mixed portfolio was just barely lower at 14.35, max drawdown much lower, or less than half, volatility almost half, and ROMAD ratio at 0.42. So even here, if you were to look at the risk adjustment, you would be better off in terms of having the mixed portfolio. October 2001 bottom, again 100 rupees invested today is 2949. In the mixed portfolio is 2638, very, very close this time from October 2001, almost 23 years. And of course, only gold was much lower than the other two. Here again, you are seeing the CAGR is almost the same in 100% case and 50-50 case. Volatility is almost half. ROMAD ratio is obviously more than double. Amazing outcome of the bottom pick also. March 2009 bottom. Again, you can see Sensex 933 from 100, 448 on gold, and 732 on the asset allocated model. Not too far, not too far. And let's see how the volatility has done. Volatility is only 11.3% in this mixed case, whereas it was 18.3% on the equities. ROMAD ratio very, very high at 1.13%. So in every case, it is showing you what the outcome is. Last case, April 2020 bottom, 100 rupees invested, and April 2020 is today 281 on Sensex, 182 on gold, and 231 in a monthly rebalanced Sensex gold portfolio. And here again, you can see 25.8% CAGR if only Sensex, 50-50 was 20.41%, volatility down from 14.9 to 10.2, ROMAD ratio 2.43 versus 3.27. So ROMAD ratio is again up, max drawdown is much lower. Again, a fantastic outcome of this. So all four bottoms tested, average returns 18.2, for sure, much, much higher average. But and gold was 11.8 in this period. That is the long-term average of gold. So, I mean, you really can't blame gold for that. Sensex gold rebalance portfolio 15.9, not so bad actually, not so bad. And if you see the max drawdown, much, much lower than Sensex in the same period. So you would have a much smoother, lesser of a fearful journey through that. And the volatility also, average volatility is 12.5 versus 20 and 15 there. So again, even if you are picking the bottom, you're actually better off, having the asset allocation. So just to sort of summarize all this, equity and gold 50-50 has outperformed both 100% equity and 100% gold in terms of CAGR and volatility during market peaks. Equity and gold 50-50 portfolio drawdown is almost 50% lower than equities, while having a higher CAGR during peaks and market bottom. So solid ROMAD ratio. 50-50 portfolio has done exceedingly well even from market bottoms. So almost matching 100% equity portfolio. So very, very consistent. And mix of gold does a great job in smoothing the equity curve and giving you a peaceful journey. And this need not be done, in terms of is a strategy. You can have your equity portfolio, but make sure you have significant asset allocation to get this smoothing and keep rebalancing them. If one portion becomes large, take the money out and rebalance it. That's how even very large institutions, hedge funds, family offices, they don't work on the principle of, I'll put 90% in equity and that will keep going up and I'll and the other portion will keep reducing to 1% or 0%. They don't work like that. They have proper allocations of how much you're going to allocate to each asset class, to each risk profile. And then once in 3 months, once in 6 months, once in a year, maybe once in a month, they will relook at all the percentages and reallocate. Just like we do a reallocation or a rebalance in a small case portfolio, that portfolio is getting rebalanced. Similarly, for a, let's say, an emerging market global fund, if they've allocated 4% to India and 9% to China and X% to some other country, after 6 months, 1 year, they will obviously relook at that and see India has gone from 4 to 7 because India has gone up. So, let's redistribute the rebalance. So that is actually the way in which you can, not only redistribute profits, but also bring in fresh equity into areas which are lagging behind. So, and these are very simple examples that I've shown, just equity and gold, and you can always have other asset classes mixed to it also. But just see the magical effect of just adding one asset allocation to your equity and how smooth of a journey it has made out of the entire thing. I think, at least for me, this data is very, very valuable. It shows you, what a great hedge gold can be, and what any asset allocation, in fact, which is not so correlated to the equity markets, can do to your overall portfolio in terms of making your journey smooth and ensuring that you stay on the path. What happens usually is that if you are overexposed to equity, in times of distress, your mind stops to work. And when your mind stops to work and you meet a few friends and they say, I'm going to sell off half of my portfolio because I think the market is going down much, much further. And that will play in your mind. And maybe in a moment of weakness, you may sell off half of your portfolio. So when you are stressed, you do all kind of stupid things. So why to be stressed in the first place? That is the question. So if you are having a proper plan, proper strategy, proper rebalance, you will not worry about it. In fact, you will not bother about it. Whether market is going up, market is going down, which stocks are going up, which stocks are going down. All that becomes, noise that you don't want to really look into at all. You are looking at it on a macro basis, that this is where I put my eggs in which all baskets, and I'm going to redistribute the baskets every month, every 2 months, every 3 months, every 6 months, and that's all. I'm going to leave it at that and let the market do its own thing without bothering about it. So let me know how you like this content, and always welcoming to your comments. I love to read them and try to respond to them as well. Do let us know what you like about our videos, and in case you don't like something, please do let us know as well. Do share these videos with your friends and family. You never know, somebody may get motivated to get into the markets, to start investing, or some advantage that some student may have in learning about the market. So do share it with your friends and family, and thank you so much. I'll see you in the next one. Bye.